Hello everyone, Corey Mitchell here with TradeThatSwing.com, and in this video we're going to look at creating a trading plan. It is a bigger document than most people think. When we start out, we think of a trading plan as, okay, we'll write down when we're going to enter, when we're going to exit our trades, maybe where we're going to place our stop losses, the patterns we're going to look for, our position sizing. These are all the fairly basic things that a lot of people include in their trading plan. But it can actually become and should become much bigger than that. Because basically every time we're trading and we have to ask ourselves a question like, what should I do in this situation? That means we have a hole in our trading plan and we need to fill it in. So why would we have a trading plan to begin with? Why can't we just, place trades when we think we see a good opportunity? Well, the idea of the trading plan is that we actually go in and test out those ideas. We look at historical data, we look at the indicators we're using, the patterns we're using, and we actually look at our charts and see what actually works. Because the idea you think is going to work may not actually be a great idea. And we don't actually know till we go back and test out how have these ideas worked in the past, did they produce an overall profit, and then we can really dig into when's the best place to get in, when's the best time to get out, under what conditions does this idea tend to work really well, and under what conditions does it not work well. And that's how our plan slowly builds over time as we accumulate this data. So you can see here with a plan, we're doing the same thing over and over again because we know it works and we can see how it performs and we can make incremental improvements over time to improve our performance. And if we're not doing that and we're just taking random trades on a whim, we don't really know what's working over the long run or over many trades because we're likely to forget. We may think we'll remember like, oh, that trade worked really well because of this and this and this, but after 50 trades, all doing different things, we're not likely to remember what really doesn't work and what doesn't. And we're also building in a bad habit of just trading based on all sorts of different things when really we should be trying to do the same thing over and over again, and we just get better and better at doing it. So I have a summary here, so I'll post this page below the video. We're looking at this article called The Complete Trading Plan for Becoming a Better Trader. So I'll post it below the video so you can see all the details because it's extensive and we're just going to kind of skim over what we should include in a trading plan. So I've made this summary sheet of what the trading plan includes. So we don't want to include without it. It's a written document or a typed document. And it includes how, why, and where we're going to enter trades, how, why, and where we're going to exit trades. So our entry and exit rules, stop losses, profit targets, trailing stop losses, indicators, anything that we're basically going to use to find where those setups are and to control our risk on them and to take our profits, we're going to include in our trading plan. Then we also want to include how we're going to control risk. So this includes our position sizing. And in this article below, I have links to figure out your position sizing, different methods. But we want to decide basically how much capital are we going to put into these trades based on our stop loss, how much of our account are we going to risk on these trades. We'd want to include any daily, weekly, monthly loss limits. So that would include if you lose a certain amount in a day, if you're a day trader, do you stop trading? And then decide what your protocol is for stepping back in. So if I have a bad day and I lose like 3 trades in a row, I'll usually just stop trading for the day and then I'll assess, is my mind right? Was I just out of my element, or maybe the conditions weren't good for my strategies? Then the next day I'll go in. But you might also have a weekly limit where it says, if you lose a certain amount in a week, you've just been trading horribly, maybe you're forced to take a week off. So you can assess these and play with these things, think about them, and then ultimately decide what you think is best for you, and then include that in your plan. We'll talk about updating the plan in a little bit. Basically, once we have it in our plan, while we are trading, we follow that plan. You also want to consider if there's a max number of positions, whether it's day trading, swing trading, investing. How many trades can you take at a time? Do you want to have to juggle 50 different positions? Do you want to only have maybe a maximum of 5 or 6 while you're swing trading? Maybe with day trading, you have a max of 1 because it's so hard to juggle multiple positions when things are moving very quickly. Or you may think, well, I can probably handle 2 or 3. You can start at that point, and then if you notice problems or that you actually have some extra bandwidth to trade more positions, then you could update your trading plan to accommodate that new information. Do you have a max amount of capital that you can put in a single position? So this might be different for day traders as it is for investors. With a day trader, you might be using all your capital on a single trade because you're watching it. You have your stop loss right there. You can get out, the market's open. Whereas for an investor or a swing trader, they're holding a position overnight. Bad news could come out overnight, which usually is when bad news comes out, is during when the market's closed. And so you may decide, I only want to put, a maximum of 20% of my capital into any single stock or any single position, just because something bad could happen overnight or on the weekend when the market's closed, and I won't be able to get out until the next morning when everyone else is also selling, and the stock or whatever it is could be way lower than you anticipated. So if you had all your capital in there, that could hurt. Will you hold through major news events or exit before? So this could include earnings releases or news releases. If you're a Forex trader, it could be the non-farm payrolls report or interest rate announcements. And these events can have a big impact on stock prices, Forex prices, etc. So you want to consider, how are you going to juggle those events? Are you going to hold through them? If you're basically, the longer term trader you are, the less impact these news will have. But, a stock, if it comes out with bad earnings, could drop 50% overnight. And is that okay with you? Or would you rather exit before earnings and then get back in if you like them? So there's a trade-off there, and there's no perfect answer, because long-term investors are basically going to have to hold through these events, and short-term traders are likely to not hold through these events. So it matters kind of where you sit and what kind of time frame you want to be trading on, and your risk tolerance as well. Will you hold overnight, over weekend, or exit before? So this kind of goes back to this prior statement. What are you most comfortable with, and how are you going to trade? And again, there's no right or wrong answer. It's you get to define your trading plan, how you will trade. How are you going to find trades? Are you going to run a scanner? Are you going to do a manual search? Are you going to listen to other people? I don't recommend that. I do recommend running your own scan, your own search. What's that scan going to look like? How are you going to find the stocks that match your entry and exit rules? What markets you'll trade and what time frames? That's a very basic one. So are you going to be a day trader trading the Euro USD on the 1-minute chart? Are you going to be a day trader looking at several stocks, but you're only looking at maybe the 1-minute chart and the 5-minute chart? Are you going to be a long-term investor only trading stocks, looking at the daily and weekly charts? Context. This one gets left out a lot, and it's basically, under what market conditions do you trade, or do your strategies work the best? So under what conditions are you going to take trades? So you may have an entry rule that says, when the price crosses above a moving average, buy that trade. But you might want to also have some other things that tell you, when does that tend to work best? Maybe it's looking at overall volatility, or a longer term moving average to say that the price is actually trending. So we'd add in these things that just say, we want overall conditions to be favorable for our entry and exit rules, and this can take some time to develop. You may at the start just have some very simple entry and exit rules, and over time you may notice, well, I tend to get more losing trades when I look at the indexes, the stock indices, and they're just chopping sideways. So that's a good indication that maybe you need to incorporate some sort of market condition filter that says I'm going to avoid trades when this is happening, and I'm only going to take trades when the indices are trending, for example. And then you need to come up with those protocols that tell you when those conditions are present and when they're not. So again, you can start to see that this trading plan starts to build out into a bigger document than just I'm going to buy when the price crosses this moving average and crosses below. You could do that. Results probably won't be ideal compared to if you also included some additional market conditions or filters. So are you going to take trades when prices are trending, ranging, choppy, volatile, and how will you determine this? Under what conditions can you exit a trade earlier than planned? So maybe you had a target in mind. You bought a stock at 100, you think it could reasonably go to 200 or 150 based on whatever you're looking at, fundamentals, technicals, and now you're in this trade. Are there any reasons that you can exit that trade early? And we've already discussed possibly some of them. Maybe conditions change. So you're no longer in a trending environment. Everything was moving up when you bought the stock. Now all of a sudden it's getting very choppy and volatile. It's a different environment. So maybe you just decide to exit that trade. Or maybe there's earnings coming up. We talked about that. So maybe all these other things that we're talking about could be catalysts that say we're allowed to exit early, or they could say, you know what, I was originally looking for a profit target. Now conditions have changed for the better. I could actually go for a little bit more. How is that going to play out? Basically, once you're in a trade, are you allowed to change your original expectation of that trade, your original stop loss, your original target, or how you're trailing the stop loss? Or so are you allowed to change it, or are you not allowed to change it? And why and how can you change it if you're allowed to? You also want to plan for improvement. When are you going to review your trades, look at them, and see how you could have done better? We also want to monitor for mistakes. A mistake is any time we don't follow our trading plan. So in the beginning, our trading plan might be very simple, so we're following it, but we notice that we could do better if we actually included some additional rules or some additional conditions into our trading plan. And then over time, we're going to look at those trades and see, okay, I messed up here. I was supposed to do this, but I actually did this. And we want to track those mistakes, because then we can look at our most common mistakes and find ways to improve on them. So I'm always brainstorming ways to improve. If I notice that I've been too eager to get into trades, meaning I'm jumping the gun a little bit, or market conditions aren't great, but I'm still deploying a lot of capital, that's a mistake. It goes against something that's in my trading plan. So I'll look at those mistakes, and I set aside some time each month to consider how I'm trading relative to how I should be trading based on my trading plan and what I've studied. And then I take my most common mistake and I brainstorm ways to improve on that. And there's all sorts of ways. If you go to the TradeThatSwing.com website under trading improvement, there is just loads of articles on improving on mistakes. And if you're getting really scared or greedy and you notice these things creeping into your trading, there's all sorts of protocols we can do to actually improve these things. Just looking at our charts and looking at our historical trades is not going to improve anything unless we actually do something about the mistakes we're making, or we dig into those trades and see, like, why am I tending to lose on a lot of these when, you know, the idea of the strategy is that I should be winning more, but I'm still losing. Why is that happening? So then we might have to go look at the market conditions that are present, or maybe our position sizing isn't quite right, or maybe we're trying to juggle too much and we have too many positions and we just can't handle it properly. So we really want to dig into why we're not improving, and look at ways to improve it and possibly fill in some holes in our trading plan to do it. You also want to consider your objectives and goals for trading, because this is going to have an effect on how you trade. Are you going to withdraw profits for income or compound returns for longer term growth? This is an important consideration because a lot of people say, well, you're a day trader, you're making really high returns, you should be a billionaire within like several years, but you can't just infinitely compound when you're day trading. And also, if you need the money, you're withdrawing your profits every month, right? If you're trading for a living, and I know a lot of people aren't, but you're going to need those profits. And a lot of people are coming to trading because they want to increase their quality of life, which means you're probably going to want to withdraw some of your profits. So you really have to think about that before you start trading. Are you going to be withdrawing? Are you going to be compounding? And why? What are your long-term goals for these things? If you do compound, at what point do you eventually withdraw it? You want to think about those things, because as that account gets bigger, it might start to weigh on your mentality and your psychological well-being. If all of a sudden that account becomes really big, you might not trade it as well because you're now thinking like, man, that's a lot of money, like I don't want to lose it. And now what you've been doing, which has been working, all of a sudden gets kind of thrown in your face, and you might not be able to do it anymore because now you're worried about losing that what you believe is a big chunk of money. So consider these things, plan them out. Are you going to trade independently for a firm, with a group, or as a business? This is a relatively minor one, I would say. You're starting out. Most people are starting out as independent traders, but you do have the option to go to prop firms. You could trade with a group, try to get a few of you together and learn it together, or you could operate as a business. Are you going to keep a job, have other income streams, or is trading going to be your sole income? And this goes back to whether you're going to be withdrawing profits or trying to compound them. If you have other sources of income, you probably could compound more because you have your own income stream and you don't need to withdraw profits from your trading. Work-life balance. What hours are you going to trade? When will you monitor positions? So the work-life balance is really important because a lot of people come to trading for more free time, and yet they end up with the exact opposite. They're looking at their charts all their time. They're constantly checking their phone to see where their trades are at. I actually set with my swing trades, I don't watch them all the time. I actually set a time when I can look at them because I have my stop loss out, I have my target out, and in the evening I can review. That's the only time I can review. I'm not monitoring them constantly during the day because I don't need to. But some of your trades you may need to. That's going to depend on your entry and exit rules, but I've basically set it up where I don't have to monitor them constantly. I set my stop loss target and I let those trades play out, and then each night I can assess the market conditions and whether anything changes, but for the most part nothing does, or I can update my trailing stop losses if I'm using a trade with a trailing stop loss. So the work-life balance, important. Consider that. When are you actually going to check positions and place your trades? And I would try to do that at the same time every day if possible. If you have a massive win or loss, what will you do? You could theoretically have a life-changing day, either to the good or the bad as a trader. Whether you're day trading, swing trading, investing, depending on what you're invested in, you could have a huge amount of profit that comes into your account, or you could get smacked. And what are you going to do? So I like to, if I have a massive win, I don't automatically the next day increase my position size to reflect this new big account. What I'll typically do is in my mind, I'll just kind of keep it separate. Let's say, one day you had 100 grand, now it's up to like 150 a couple days later. So huge jump, 50% jump in a couple days. Maybe you had some stocks that got bought out or something like that. I still think of my account as 100 grand, and that 50 is just kind of separate until I decide in my head how I'm going to use that capital. And maybe I'll decide to withdraw it, or maybe keep it in the account and then build up my position sizes to reflect that larger amount of capital. Whatever it is. And it doesn't matter what size account you have. If you have $1,000 account, $100,000 account, $1 million account, what's big to you? What's a massive win? What's a massive loss? Consider what you'll do in those scenarios. And if you have a big loss, maybe you take a couple days off just to absorb it. And a lot of times if we jump right back into the market, we're going to be aggressive. We're going to be revenge trading. And so we want to sidestep those problems if we can and give ourselves a day or two to figure out what to do with this loss or with this big gain. Will you listen to other people's input? Why or why not? I do not listen to other people's input. I do not care what other people are trading. I do not watch business news. I do not look at other people's trades. I do not look at what they're watching. I could really care less because I have my own trading plan and my goal is to follow it. So as soon as I add someone else's input in, I'm more likely to deviate from my trading plan. If you do decide, you may decide maybe there's someone you really respect and you like looking at their watch lists. For example, I have trading courses and I publish watch lists of what I'm watching. And if you're following that method, you may use my input. Look at my watch list. I do recommend you run your own scans. But if you're limited for time, maybe you do use my scan list and you look for, and you consider the stocks that I'm looking at. But you'd want to consider, why are you following them? Who are you going to follow? So that you don't get drawn in. You go on Twitter or you go on Instagram and you see someone posting about a certain type of trade. You shouldn't just jump on that trade just because someone said to. That goes against the trading plan. Unless that trade, you would have to filter it through your plan first. So someone might say this trade looks great. You would have to go through and look at your own trading plan and say, you know what, that doesn't fit my trading plan. Or you might say, yeah, you know what, but I'm going to follow my own entry rules, my own stop loss, my own position sizing for it, so that you're trading your plan even though you may have taken someone else's idea. How much will you save each month for a rainy day? Savings very important. Trading is not a fixed income type business in the sense that you're going to make the same each month. It's not like a salary. So you might make a lot this month, you might lose some next month, you might have a big month the following month, you might make a little bit the following month. You know, it goes up and down. It's not going to be the same each month. So consider that. How much are you going to save? Just like any other job, you need to save. You're going to pay taxes on your trading income. How will you pay these? It can be a really big bill if you have a good year, so you also want to be putting your taxes aside and making sure that you have that money available to pay in installments or at the end of the year, depending on how it works in your country. So that's a lot already, and this article goes into a whole lot more. What I want to jump down to is updating your plan. Anytime we update the plan, or as the plan stands, that is how we trade. And that is how we manage our new trades that are coming up. We can only update the plan outside of trading hours, and I say this because it's very easy to, if you're in a losing trade and it's about to hit your stop loss, there's the impulse to, well, I'm going to move my stop loss and I'll just update my trading plan. But now the market and your emotions are forcing you to adjust your trading plan, when really you want to only adjust your trading plan when you're calm, you don't have anything on the line. So if you find a flaw in your trading plan, I would close out your positions, think about it, work on it, update your trading plan, and then begin trading again. We don't want our emotions and things that we're seeing in the moment to cause us to change everything that we've studied. The point of the trading plan is that we study the market, we study market conditions, we study our entry and exit rules, and we find the best way to implement them. And then we do that over and over again. If we're constantly changing it, we're missing the whole point of having the trading plan in the first place. If we just get knocked off course every time we have a little losing trade or a winning trade and we're afraid of losing our profits, we have to follow our plan. And so as long as the current plan is in place, we follow it. And then basically we have to close out our trades or make adjustments to that trade so that we're not doing it under duress or influence of strong emotions where we just want to change our plan because we don't want to take this loss we're in. And of course we know that we do need to stick to our losses, our stop losses. We need to cut them. We need to take profits when we're supposed to. And we don't want to be swayed by these emotions and impulses that can come in. So you basically follow the plan you have, and if you want to change it, close out your trades and or wait till your trades are closed out according to the current plan, and then you can think about what updates you want to make. You don't want to back test, and any additions you make to the plan should be well studied, researched, look through charts, think about it, and then include it in the plan. So you can see some other features you might want to add in. You might want to also add in what's your daily routine for your trading. Short-term and long-term objectives we talked about. You also might want to make up some cheat sheets or checklists. What has to be in place on every single trade in order for you to take that trade, and do you have to go through your checklist before making a trade? I recommend it. Even if it's day trading, you might have a mental checklist that you go through, and that would be part of your trading plan. That's part of your trading process, is to have this daily routine, maybe a morning routine before you start trading. You might have checklists that you go through. So these are things that you can go in to help keep you on track for following your trading plan. Psychological issues can come up. You might find that you're very greedy. You may be getting scared of trades and you're not taking them when you're supposed to. And again, lots of resources on the trading improvement section of the course for handling those types of things. And really, there's just anytime you have that moment in your trading where you're thinking, what do I do here? That's a hole in your trading plan and you need to fill it in. So add it into your trading plan document, whether it's on your computer or you have it written down, and continually update that plan. But again, we don't want to be updating it under the duress or the influence of current trades. Try to really back test and do some thinking about what's best for your trading plan, not just maybe the particular trade, but overall results, and then update your trading plan accordingly. And then while that plan's in place, you are following that plan with every trade you take. And anytime we deviate from that plan, that's a mistake, and then we can look at how to improve our mistakes over time. So it's actually a pretty thorough document, and it's not just about trading, it's about how do we adapt our life to our trading, and how does our trading adapt to our lives, basically what our goal is. So I like to look at what I want my life to look like, and then I create trading strategies around that, as opposed to letting the market dictate my life, because then I might be sitting in front of the computer all day, which is not what I want. So I hope that helps you out in building a more thorough trading plan. Build it up over time, and happy trading.